Hello and welcome to Damien's Market Update, the show where I talk about what's been going on in investment markets and what to look out for in the weeks ahead. Now, before I start this show, as ever, if you're watching this on YouTube, please make sure if you found this useful in any way that you hit that like button, you tell people about this show, and you also subscribe to our YouTube channel. As usual, you can ask any questions in the comment section below this video, and I will do my very best to answer those. So please make sure you enter those comments, because it does also help our videos in the YouTube algorithm as well. So what's been going on in investment markets? Well, what a difference a month makes. So at the start of August, you may recall the market's expectation of where interest rates would be in the future were tumbling, particularly in the US. Now, this was positive for US tech stocks and bonds in particular, but of course, such is the power of the Fed that similar positive market moves were seen globally in stocks and bonds. Now, the strength of the rally at the time raised the question of whether we were witnessing the formation of a new bull market in equities after we'd had the bear market that had been characterizing much of 2022. And the alternative, of course, was that we could just be having another bear market rally or a so-called failed breakout. Now, as it turns out, with the benefit of hindsight, it was actually the latter, a failed breakout. Now, the comparisons I drew back at the beginning of August with similar stock market rallies during the dot-com bust and the financial crisis, ultimately they ultimately fizzled out. Those comparisons turned out to be pretty accurate. Now, we will now see whether stock markets roll over to set new bear market lows, as they did in those historical examples that I gave, but we will have to wait and see if that occurs in 2022. But it's something I'm going to come back to later in this video about whether we might revisit the lows of this year or see new lows. Now, during the first half of August, the buy the dip mentality was evident in equity markets, something we hadn't seen in the first half of 2022. And those of you who subscribe to my 80/20 investor service know that I've been highlighting the usefulness of technical analysis in the current environment in order to make sense of the noise and the ever-changing market narratives. And it allows you to ignore a lot of that noise. And that noise has mostly been centered around trying to second guess what central bank policy decisions will be. Now, if we focus on the US stock market and the S&P 500 in particular, at the start of August, the index was at 4,150. Now, in my newsletters, I've been stressing the importance of the 4,300 level in the S&P 500 and the 4,500 level in determining the future direction of the market, in particular that rally that we had. Now, given that the euphoria of the market rally was built upon the idea that the US Federal Reserve would no longer be hiking rates aggressively and they'd effectively pivoted because inflation had peaked, then I cautioned at the time that it left the rally vulnerable if those assumptions were challenged. Well, ultimately they were. And sometimes technical analysis can work beautifully, other times it can be less reliable. And in August, it was a great example of where it worked beautifully. Now, the S&P 500 rally failed precisely at the 4,300 level, which also pretty much coincided with the 200-day moving average at the time. And now I've drawn a simple technical analysis chart, which if you're listening to this, or I should say watching this on the YouTube channel, because we do release these videos as a standalone podcast on our podcast feed, which you can find via any of the podcast apps that you like to use. But if you're watching this on YouTube, then on screen you will see a copy of that chart, which highlights those key levels and in particular that 200-day moving average. Now, I used Yahoo to make the chart, and Yahoo has a free tool which you can use and it will remember the levels that you put in. So do have a play around with trying to create some of your own technical analysis charts, because they are quite simple to draw, but it does give you a bit of insight into where key levels lie in markets and those key lines of resistance and support. And I've added those on there for you to have a look at. And you can see that right on cue at the 4,300 level, the S&P 500 rally collapsed and the market eventually broke down below the 4,000 level and ultimately the 3,900 level, which is where we are now. It means that bearish investors are back in control and that the buy the dip mentality that had been characterising much of July and August rally has now turned into the sell the rip. So effectively, bears are back in control. Now, you can also see that the collapse has confirmed that we do remain in a downtrend dating back to late 2021 that I warned about in my last video. Now, that's despite the fact that the S&P 500 actually broke out of a shorter term downtrend that dated back to earlier 2022. So we are still at this moment, as I make this video, in that downtrend. Now, unless the bulls start buying soon and pushing the index back up, the S&P 500 is in danger of revisiting the lows of June and has the possibility of making new lows in 2022. As an aside, the S&P 500 has actually closed below its 200-day moving average for more than 100 trading days, which is the longest streak since the financial crisis. So again, you can see these comparisons back to 2008, which isn't any kind of comfort for us investors. Now, that is pretty bearish in itself. Don't forget that the 200-day moving average is broadly seen as a measure above which is a bullish zone for investors in that particular index. Below that, then it is seen as bearish. Now, the catalyst for the market slump in August was the Jackson Hole Symposium, which is where the Federal Reserve Chair Jerome Powell gave a very hawkish assessment of the future path of the central bank's monetary policy. Now, this challenged the market's dovish pivot narrative that we'd seen, and it had driven their rally higher in July and August. And of course, once that had been challenged, then what we had was the market quickly unravel, and it meant that US stocks endured their weakest August performance since 2015. Now, that weakness in US equities was reflected globally, as you would expect. For example, the German DAX fell by 3.37%. In August, the FTSE 100 fell by 1.88%. And if you take the MSCI All Countries World Index as a broad measure of the performance of equities around the globe, then that fell by 3.13% during August. Now, the real bright spot was the Japanese Nikkei 225, which rose over 1% for the month of August. And that was buoyed by the yen hitting a new multi-decade low against the US dollar. And that is a boon for Japanese exporters. So that's why you'll be seeing Japanese funds appearing in some of the best performing charts that you might see on the platform that you use, for example. But August wasn't just a bad month for equity markets. Bond funds also tumbled as bond yields burst higher as markets began pricing in more hawkish policy decisions from central banks. UK corporate bond funds had their worst month in 4 years. UK gilts also had a dire month as concerns grew over the scale of government borrowing required to cope with the cost of living crisis. Now, if you just focus on the UK for 1 second, the prediction of where the base rate will be a year from now, so September 2023, jumped incredibly during the month of August. Say at the start of August, the market was predicting that we would have a base rate of between maybe 2.53% this time next year. And at the moment, the base rate is 1.75%. Well, by the start of September, the market is pricing in that we can expect the base rate in the UK to be above 4.25% by September next year. That's going to be bad news for anybody who's coming off a fixed rate mortgage between now and then. Now, with bond and equity markets falling in tandem during August, it was reminiscent of the first half of 2022. So the typical 60% equity, 40% bond portfolio struggled through its lack of diversification, and it meant that it fell by around about 1.75% during August. Now, in contrast, my own 50k portfolio, which is run on the 80/20 investor service, is much more diversified beyond just bonds and equities, and it produced a positive return during what was a tricky month for equity markets. And that's thanks to its low bond exposure and the inclusion of commodities and energy stocks, which did have something of a rebound in August, which we'll have to wait and see if that continues, because obviously if we start to get recession fears really surging, that tends to impact commodities. Now, the weakening of the pound also provided a positive contribution to parts of my portfolio. It probably would have done yours as well. In fact, the pound fell more than 4.5% against the US dollar during August, which is the worst monthly performance since the Brexit referendum in 2016. And it's a further harsh assessment of the UK's economic prospects in the coming months. And now the pound is at a 37-year low against the US dollar. And that means if you've got any assets held in the US, you may have US equities, for example, then that's giving you a real currency boost over the last month, which will be obviously good news for your portfolio. Now, we are a week into September, of course, and September is a month that history tells us is the weakest of the year for stock market returns. So we have got a seasonal headwind that's hitting us right about now. And if you look at markets since the start of September, then across the board, they are down. And we have started the month off pretty poorly. The FTSE 100 is down to 7232, and it's stuck in a trading range between 7,100 and 7,300. Now, if we can break above that 7,300 level, then we would probably go looking for that 7,500 fairly quickly. That's what tends to happen. If we break below 7,150, then keep an eye on the 7,000 level, because the bottom could really fall out of the market. As we continue into September, well, the pressures remain on bond markets, with yields on both UK gilts and US treasuries soaring in recent weeks, and they have been continuing to do so in September. At the moment, the 10-year US Treasury yield is back at 3.3%. That is some surge that we've seen in the last month. And the 10-year UK gilt yield is back above 3% as investors start worrying about the pace and ultimate level of central bank hikes around the global, in this case, the US and in the UK, especially as some forecasters are predicting we could see inflation in the UK surged to 18%, which is pretty depressing. But with the UK and Europe set to announce plans to cap energy prices, then there may be some respite from inflation for consumers. But it won't be as much as people might hope. In the UK, despite them saying that we could see inflation at 18%, if we do get some kind of energy price cap in the coming days, it's only going to knock about 4% off of the inflation rate, which would take it down to around about 6%. That means that central banks, in this case the Bank of England, will still need to be pretty aggressive if they're going to get inflation under control. And if we have a bit more money in our back pockets as a result of a price cap freeze, then maybe the Bank of England has that bit more room for manoeuvring in hiking interest rates going forward. It's a difficult conundrum that the central banks have, in particular the Bank of England. Who knows what's going to happen? We're going to have to keep an eye on that. But what it does mean is that we are far from out of the woods. And at the moment, the market believes that central banks are going to be hiking pretty aggressively. And if history is our guide, then what tends to happen is that central banks hike aggressively at this stage of the cycle until they break something. And that could be investment markets or the economy. So things are likely to get worse before they get better. So that is it for this month's show. If you found that useful in any way, then please make sure you like the video, leave any comments or questions, and I will do my best to answer those. And please tell people about the show and the channel, and make sure that you subscribe to it too.